What's going on? We're going to be going over Alibaba Group Holdings. Over the course of the last year, basically flat. Year to date, they're up 3%. Now you guys might want to buckle up and grab a bucket of popcorn on this one because I think this might be a bit of a long video. There's a lot of information to cover here, but this is also a potential for a good buying opportunity on Alibaba if if it's something that fits your portfolio or your trading plan. So we're gonna hop over here. I want to go over the most recent quarterly results of Alibaba. In their report here, they're saying they bought back $3.1 billion worth of shares, and they also are stating they have continuous generation of strong free cash flow, which you will see they do. Our strong free cash flow and balance sheet puts us in an excellent position to strengthen our competitiveness and capture new opportunities. Also agree with, especially with the economy that's going to be in a headed it's towards a recession right now. But that's another thing we'll take a peek at. Is there's a news article that kind of sums up the economy of China at the moment, and it's not all as bad as everybody's making it seem. It's definitely not great. Revenue increase 14% year over year. Income from operations an increase of 70% year over year. Net cash provided by operating activities increase of 34% year over year. Free cash flow increase of 76%. So it kind of tells you maybe Alibaba's starting, maybe it hit the bottom and now it's maybe going to start working its way back up. So in their next section here, they kind of have it broken down by each section of their business here. They have a statement here of order growth of AIDCs, which is their Alibaba International Digital Commerce Group. Retail business was around 25% growth year over year. Their local service group grew 35% year over year due to more efficient acquisitions and retention of consumers, as well as an increase in user demand. And they're still seeing, people spending, which is good. Maybe people aren't spending enough to bolster up the economy. Well, in this statement here, they have two businesses, LEME and AMAP, I suppose you'd maybe pronounce those. AMAP is the mobile digital map navigation real-time traffic info in China. Provides same data to international and domestic vehicles. So it's basically your GPS, right? And then LE.me, whatever, is used to, it's kind of like an Uber Eats, where you use it to order meals, food, groceries, and other products to have them delivered. Next, one of these next businesses here grew 34% year over year, and driven by an increase of revenue from international fulfillment solutions services, as well as domestic consumer logistics services. Keep on growing down here. I think this is one of two businesses that Alibaba runs, and it was only a 4% growth year over year, which is their cloud business. And I put a little note here, is the only service that didn't substantially grow, but it also maybe never declined like the rest of their services. I looked back in the previous quarters, and it appears to be true where their cloud business did not decline, it just slowed down. It went from like 10% growth, had one negative quarter, I believe, of negative 2%, and then it's just kind of sort of just holding steady at like a 4 or 5% growth rate. So that's probably why, because the cloud business is not likely to be affected as the consumer business will be affected. Next, they got a digital media business as well, which for what I could read up on it, it seems like it's very similar to like a YouTube, where it allows users to search, view, and share video content. And that was a 5% year over year growth. Okay, so one of the big things I like too is the operating margin went from 12% to 18% year over year. Very nice. Very well done. Keep going. We have all quarterly show. Okay, here's the cloud business that I was telling about. If it grew or not year over year, but year over year, it grew, and it didn't appear to be any decline in the cloud business. All right, so come down here to the balance sheet. Alibaba has $70.3 billion of cash, just waiting to be used for something. And they've currently got $52.4 billion of short-term debt, $36.4 billion of long-term debt, with a total $86.8 billion amount of debt. So they've almost got enough cash to cover all of their debts. And based on their free cash flow, they could probably pay off all their debt within 1 year. Not just out the free cash flow, but if they use the cash on their balance sheet plus their free cash flow, they could wipe out their entire debt and still have money left over at the end of a full year's term. So come down here a little further. There's your total liabilities, 86. So you come all the way to the last page. They saved the best for last, in my opinion. Here, we'll do this in U.S. dollars. Here, they brought $6.2 billion, and mind you, this is in 3 months. $6.2 billion to cash provided by operating activities, and then they have some capex here. So they have a free cash flow of call it $5.4 billion in 3 months, which puts them at $21.6 billion free cash flow annualized. That's healthy. You add this in plus the $70 billion of cash they've got sitting on the balance sheet, you pay off your debt and you still have $5 billion left over. And then on top of it, they're buying back shares. I think, what was that, $13 billion of cash they're going to use to buy back more shares. Like, they've got the money to do it. There's no reason for them not to do it, really. So they have $16.3 billion remained under their current share buyback program. So there's no concern that they can't, pull money and do that, especially with their free cash flow. And I think now, based on once we hit to the valuations, now is a great time. So over here we got Baba typed in. Negative there a little bit is only a return on invested capital of 7.4. So we come down here. Analysts have an EPS growth rate on this on average for the next 3 years of 13%, revenue growth 9% for the next 3 years. And those come up to here, gives us a Peter Lynch value, of 0.6, tells us it's overvalued, fair value of $57.71. We got a couple multiples here to compare to. All those multiples give us an average buy price on Bob, or fair market value price, of $245 per share based on comps. Manual PE, current market cap, $241 billion, $75 billion in cash, $86.8 billion in debt. Cash from operations is $29 billion annualized. Multiples per year, 8.7. That's how many years it would take for Alibaba to reach its current market cap in 8 years. I think this is the lowest one I believe that I've seen. If not, it's right there. It's low. Total assets, $245 billion in assets, $87 billion in debt. Outstanding shares, 2.5 billion or 2.5 billion shares. Gives them a price to book ratio today of 1.54. Average price to book is 4.5. Forward looking PEG 1.05, even with like a very minimal low growth rate of, I believe, was at 9. Yeah, 9. That's basically a 1-to-1. So that's also very attractive. So we come over here to Graham's valuation. I've put in 1.5 for the stable, mature company. I feel like it's relatively stable and mature of a company. I tried to find the most credible source for China's AAA corporate bonds, and I kind of just took the median of what I could find of 3.09 and gives it an intrinsic value of $177 per share. Next up is discounted cash flow. Typed in all my information. Got a weighted average cost of capital of 6.08. 6.08 populates up here. 2.5% perpetual growth rate. Cash from operations. Very, very nice. Lots of cash from operations from this company. Even in a bad economy, this company still put out $29 billion from cash for operations. Another thing too to note is that even though their capex has it's been in that I would guess 3 to 5 range. Had one big capex, 8.4. Anyway, capital expenditure currently sitting at about 5 billion. Nice decline from where it kind of has been, which gives them a $24 billion free cash flow annualized. And as you can see, that seems to be, it's slowly growing. Grew quite a bit. 2022, rightfully so, declined quite a bit. Because of their China being shut down for the last 3 years. And then opens back up to where it needs to be, and appears to be heading very strongly back up to how the company was how much money the company was making before. So come down here, cash and marketable securities, $75 billion, gives them a DCF of $515 per share. Also to note that the average growth rate was 16%. Analyst growth rate was 18%, so I gave them the lower end of the growth rate for future free cash flow there. Rule 72, current EPS 4.47. The current lowest EPS is 12.91. The EPS is 12.91. Yahoo Finance is the other source I go to for EPS, and they only had 1.44. I'm not real sure why there's such a big difference here. Maybe Yahoo doesn't. Maybe their analysts on there don't, or haven't, or not enough of them have analyzed Baba, and that's why. I don't know. So I decided I'm going to do 7.5, kind of just go in the middle of that range, I suppose. And then, so I put 7.5 in. 7.5 goes into 72 9.6 times. 9.6 goes into 10 years, a little over 1 time. So 4.47 turns this into, about 9 for future EPS here, which gives them a fair value of $58, 30% margin of safety of $40 per share. So now over here on the summary of all our valuations that we put in, we have an average price of $210 a share, which a purchase price of a 30% margin of safety of $147.50 per share. So clearly very, very, very undervalued, trading at $95 a share. There's a lot more good than bad that I could find on this on Alibaba here. Growth is picking back up in the business. We could see that just based on the the percentage growth year over year. They have very nice free cash flow with plenty of money at the end of each quarter to do really whatever they want. If they want to buy more businesses, buy back more shares. I mean, even if they wanted to, they could maybe start doing dividends too. I suppose that'd be attractive to a lot of people, I think. They're very well diverse in the China economy. They have, I believe it seems like they're somewhat similar to Amazon, where they just have so many different businesses. They're buying back their shares and have approved more capital to do more buyback. They grew their operating margin by 18% year over year, decreased their net expenses by 6%. The bad things, very obvious, is that it's located in China, and the China economy is sliding towards a recession. However, the recession is not quite there yet, but the arrow is pointing towards it. Other than being located in China, I don't see a lot to dislike or complain about this company. They have a tremendous amount of cash on the balance sheet and almost more cash than total debt. One real quick thing is I pulled up this news article, and I'll just read this section off real quick. If I had to use one word to describe the current situation, this is talking about China. it would be fragile. The economic data we've gotten over the past few months have largely painted a gloomy picture. Chinese households are spending less than expected and saving more instead. Businesses are borrowing and investing at a reduced pace, and while the overall job situation has been stable, unemployment among the country's youth has jumped so much that Beijing decided to stop releasing the data. So down here, as downbeat as all that is, it's important to note that the economy is not crashing. Economists are still expecting Chinese gross domestic product to grow at 5.1%, and 4.5 next year and 4.6 in 2025. By comparison, the U.S. is forecasted to grow at 2%, and 9.9 next year and 0.195. So technically speaking, China is still going to be growing more than we are. So I figured that was kind of something that was a little key takeaway there, because I mean, your GDP is a big key indicator of how your economy is. Now we'll hop over to the stock chart here on Alibaba. I'm on a monthly time frame here, and we got our IPO over here in like middle of 2014, and we have what appears to be a pretty solid support range at about 50, probably call it $60 a share, and we retested that range here back in probably the October area when everything else was selling off. And currently we are in this big massive we were in this big massive downtrend, right? Now we appear to be creating some sort of a wedge form here. We're making higher highs, but we're still making lower highs. Or sorry, we're making higher lows, but we're still making lower highs. So we might be kind of trading in this channel here, maybe for the next, probably for the rest of the year, possibly. Maybe. Might need one or two more earning reports. Also probably going to need some sort of China confirmation that, okay, China's not going to go, or their economy is going to start turning around and things are going to start looking a little better over there in China. I think once that happens, then Alibaba's got some leg room back up to, it's $200 range up here. I mean, the valuation says it's got it. The balance sheet, there's nothing to complain about there, in my opinion. And based on technicals, is Alibaba's oversold, but it has a reason to be, and I think investors are just kind of waiting a little bit to see where China goes from here. I think China's the big reason why Alibaba's down here, and I don't think it's the stock itself. I think it's China. Overall, I'm a big fan of Alibaba here. I like the valuation. I love their balance sheet. Very strong balance sheet. The one big thing is China, because the Chinese government can do whatever they want. So let me know down below your guys' thoughts on Alibaba here. I think this is a pretty good company worth looking at investing into, honestly, in my opinion. And I personally will probably look a little bit deeper into the whole Chinese economy, but this might be one of those things where when there's blood in the streets is when you buy, and that appears to be maybe one of those scenarios here. And a little side note, I believe, isn't it Charlie Munger, who I think he owns quite a bit of Alibaba in his own personal portfolio, but he also bought at like $126 a share, I believe, somewhere around that range. So, when one of the biggest investors in the world is buying this company and bought it at a higher price than what you can get it for, that's another little confidence, conviction, I would suppose you would call it. So, but yeah, so that's it for this video. If you found value in this video, consider liking and subscribing, and I will be back tomorrow with another video on Tesla.